We hear it all the time. The Nasdaq's up 4%. The S&P 500 is down 3%. But what do those numbers mean? Let's say on a given day, the S&P TSX Composite Index is down 2% to 12,089. The number, 12,089, is the value of the index. But what is an index, and why is it important to understand? Here's the official definition. An index is a compilation of stocks, bonds, or commodities representing a particular market. Each index is weighted differently, and its value measures the change in the market by monitoring the escalating or descending values of the companies or securities listed. But what does that mean in plain English? Here's Diana Avigdor, portfolio manager and head of trading with Barometer Capital.
So there's different kinds of indices. They represent a sector or a geographical area or a combination of things, but it's defined as such, and the stocks that go in represent that sector or that country. This way you can watch the general level without having to drill into, for example, the S&P 500. So by watching one price level, you can sort of see what the market is doing at any given point in time.
So each index calculates its value in one of two ways. It can be either a market cap weighted index or a price weighted index. In a market cap weighted index, larger companies account for a greater portion of the total index, and smaller companies account for a smaller portion of that same index. This is important to consider because when a large company experiences volatility, it moves the index. Here's Diana Avigdor.
On the NASDAQ 100, with Apple rising the way it has, say over the course of the last year, it was the most heavily weighted, and hence it was swinging the index. The index was being swung around by the force of one stock. So if that one stock suddenly, say, goes down, it really impacts, or goes up, it really impacts the index unproportionally to the other stocks.
The other type of index is a price-weighted index, such as the Dow Jones Industrial Average, which lists 30 actively traded blue-chip stocks. The value of the index is created by adding the prices of each of the stocks in the index and dividing them by the total number of stocks. As a result, stocks with a higher price have more weight in this index and influence it more than low-price stocks.